Hi, and welcome back to the Food Fund, where we explore all things related to investing in food and beverage stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in great companies. If you love food and love stocks, you will definitely love this channel. In this video we will be doing an analysis of Kroger and seeing if the largest grocer would be a great addition to the Food Fund. Be sure to watch through the end of the video where I share my final thoughts on that. Now, let's go ahead and jump right in. Cue the logo. Let's start with some background info on Kroger. Kroger was founded in 1883 by Bernard Kroger in Cincinnati, Ohio. The company started out as a small grocery store, but it quickly grew into a major player in the grocery industry. Today, Kroger is the largest supermarket chain in the United States, with over 400,000 employees and more than 2,700 stores in 35 states. Now to the price action. Starting with the 1-year chart, we see that Kroger had a CAGR of about -3%. Zooming out to the 5-year chart, we see that Kroger had a CAGR of about 8%. Kroger price action has been stagnant as of late, but it had a big boost from inflation in recent years. Now, let's take a look at the fundamentals. Gross margin is 23%. This is pretty good for a grocer. Revenue has compounded at around 4% over the past 5 years and has reached nearly $148 billion most recently. Good revenue growth and good gross margins make for a sound company. Looking at cash flow, we see a 10% CAGR in operating cash flow over the last 5 years, while capex has grown at a CAGR of 4%. Thus, free cash flow has grown at a nearly 21% CAGR. Here we see that free cash flow has flourished due to the manageable growth of capex and strong operating cash flow. This looks very nice. Weighted average shares outstanding have been decreasing at about almost a 3% CAGR, going from 818 million shares in 2018 to 725 million shares most recently. Kroger has been very busy buying back shares. This is a great use of their free cash flow and has catalyzed their good share price appreciation. Now let's view return on invested capital. Return on invested capital has increased from 6.2% in 2018 to 7.7% in 2023. Though the return on invested capital is fairly low, the increase over time means that efficiency is getting better, and I like it. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 8 days in 2018 to 3 days most recently, Kroger has gotten a comparatively more efficient managing inventory, though their most recent cash conversion cycle value is not negative. 3 days is still a pretty good value. Last, let's explore Kroger's debt. The most recent net debt to EBITDA is good at 2 and has been declining from 2.8 in 2018. This is a very good sign that the company is slowly paying down debt relative to rising earnings. The fundamentals of Kroger are pretty strong. But is it right for the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thought. Okay, let's go to the spreadsheet and write out some key values for Kroger. It is a grocery company with a gross margin of 23%. The 5-year revenue per share CAGR is 7% and the 5-year free cash flow per share CAGR is 24%. Kroger has a strong gross margin and good growth. A return on invested capital of 8% is pretty low, but it has been increasing over time. Next, the cash conversion cycle of 3 days is good and continues to improve. I would love to see this value flip negative, but it is on its way. Concerning debt, a net debt to EBITDA of 2 means that Kroger could pay off all of their debts with about 2 years of earnings. So from a fundamental standpoint, Kroger is actually pretty good. Now let's switch our attention over to valuation. Kroger is a little undervalued relative to the S&P 500 with a ratio of 0.8. The price to earnings growth, or PEG ratio, is 1.6, which means that Kroger is just slightly overvalued compared to its projected earnings growth. Kroger is a surprisingly solid business. Despite consumers having multiple options from which to shop, Kroger is able to maintain strong gross margins. Grocers are very keen to pass on their costs to consumers, as noted by their healthy gross margins, so inflation has been a big help to their business. Additionally, their deal to acquire Albertsons will allow them to grow revenue and gross profit with mild incremental cost to their operating budget. All in all, I am pretty impressed with Kroger. This is definitely going on the watch list. Many thanks for watching. What do you think about Kroger and its fundamentals? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.